This is not a bad day in the market. This is not a surprise headline. This is the predictable endpoint of a machine that has been running for years, quietly, mechanically, and without mercy. A move toward the 94 handle isn't just a number on a chart. It's what the system reaches for when the scaffolding of confidence finally has to be repriced. Here's the shocking claim you need to sit with. The next violent break will not happen because investors panic. It will happen because the plumbing forces liquidation at the exact moment positioning becomes one way. And right now, positioning is becoming one way. Consider the scale of the backdrop. The Institute of International Finance reported total global debt around $345.7 trillion by the end of September 2025, roughly 310% of global GDP. That's not high, that's gravitational. At the same time, U.S. federal debt is being tracked around $38 trillion plus in late 2025 or early 2026 ranges by official monitoring and fiscal reporting. And interest costs have been accelerating with higher rates, meaning the system is paying more just to stand still. Now layer in the quiet signal almost nobody respects until it's too late. Foreign holdings of U.S. Treasuries hit a record $9,355 trillion in November 2025, even as China pulled back to about $682.6 billion, its lowest since 2008. That combination tells you something crucial. Demand is not disappearing. It's shifting hands, shifting motives, and shifting time horizons. And that is why what's happening now is inevitable. Not because markets are evil, not because they are omniscient. Because once a system reaches this debt density, it must periodically manufacture volatility to reset leverage. The crash is not a glitch, it's the reset. So if you want the real explanation for a potential $94 crash, you don't start with headlines. You start with a pattern, one that repeats across empires, currencies, and credit cycles because it's built into how confidence is financed. Here is the pattern, fixed and universal. 4 stages that show up in every major monetary breakdown. Stage 1, the setup. A credibility anchor is established, gold, a peg, a reserve status, a treaty, a central bank promise. The world believes the anchor will hold. Stage 2, expansion. Once credibility is accepted, leverage expands on top of it. Debt grows faster than productive capacity. Liabilities pile up because the anchor guarantees stability. Stage 3, crisis. Reality collides with math. The anchor is tested. Deficits, reserve drains, refinancing walls, or external shocks expose the overextension. Speculators don't cause the weakness, they locate it. Stage 4, the inevitable outcome. Devaluation, default, capital controls, forced restructuring, or a new regime of policy. The promise is rewritten. The public learns the anchor was conditional. That's the mechanism. It's not political, it's not moral, it's structural. Now I'm going to prove it with history. 3 separate case studies, 3 different eras, same machine. First case, Britain, 1931, the gold standard breaks. Stage 1, the setup. Britain returns to the gold standard in 1925, the pre-war parity. It's a credibility ritual. We are stable, we are sound, we are the anchor. Stage 2, expansion. But the parity is misaligned. To defend gold, policy tightens. Trade competitiveness weakens. Capital becomes skittish. The system survives only by leaning harder on confidence, exactly when confidence should have been least demanded. Stage 3, crisis. The Great Depression bites, bank failures spread. Gold reserves face pressure as outflows intensify. The anchor is tested not by ideology, but by withdrawals. When enough holders of claims ask for settlement, the illusion must produce metal, or it must break. Stage 4, the inevitable outcome. Britain suspends gold convertibility in September 1931. The pound devalues. The promise is rewritten. The public is told it's necessary for stability, but the real reason is simpler. The math didn't balance. The anchor could not carry the liabilities built on top of it. Notice what happened. The collapse wasn't sudden to insiders. It was the final stage of a multi-year overextension where credibility was used as a borrowing platform. That's the pattern. Second case, Black Wednesday, 1992, the ERM breaks. Stage 1, the setup. The UK pegs the pound within the European exchange rate mechanism. Again, a credibility anchor. We will defend this band. We will not devalue. Stage 2, expansion. The peg invites borrowing and positioning because it signals reduced currency risk. But the UK's inflation dynamics and interest rate needs diverge from Germany's. Defending the peg requires policy that hurts the domestic economy. The more it hurts, the more political resolve weakens, quietly then rapidly. Stage 3, crisis. Speculators attack, not out of villainy, but out of arithmetic. If a central bank must burn reserves and raise rates to defend a level the economy cannot tolerate, the market can pressure it until either the economy breaks or the peg breaks. That's a one-way bet when the imbalance is real. Stage 4, the inevitable outcome. The UK exits the ERM. The pound falls. The anchor was not defended because it could not be defended without destroying the system it was supposed to stabilize. Again, speculators didn't create the fragility. They exploited the mismatch between promise and capacity. Third case, Thailand and the Asian financial crisis, 1997. The dollar peg becomes a trap. Stage 1, the setup. Thailand effectively pegs the baht to the dollar. Credibility anchor. Currency stability, investor confidence, easy cross-border capital. Stage 2, expansion. Capital floods in. Corporates and banks borrow in dollars because rates are lower and the peg removes risk. Debt grows in the wrong currency. The economy looks strong because credit is strong, but the strength is borrowed. Stage 3, crisis. Export competitiveness erodes, reserves get strained, and the market realizes the central bank cannot defend the peg forever. Speculators attack. Reserves are spent. Rates spike. The system begins to seize. Stage 4, the inevitable outcome. The peg breaks in July 1997. The baht collapses. Dollar liabilities explode in local terms. Contagion spreads across the region. That is the machine in its purest form. Credibility anchor. Foreign currency leverage. Reserve drain. Break. Now, take a breath, because here's the point. Those three histories are not interesting stories. They are demonstrations of the same mechanical pattern. And now we apply the pattern to the present. We start with stage 1, the setup. The modern anchor is not gold or a peg. It is reserve status, dollar settlement, treasury collateral, and the assumption that U.S. obligations are the global risk-free base layer. The dollar index itself was created in the early 1970s as the world moved into a new monetary regime. The anchor is confidence in liquidity. You can always sell treasuries, always settle in dollars, always refinance. That anchor enabled an entire planet to build leverage on top of it. Check. Stage 2, expansion. Now look at the numbers again. Global debt around $345.7 trillion by late 2025, per IIF, an altitude where small yield moves create enormous refinancing stress. U.S. federal debt tracked north of $37 trillion in 2025, and higher ranges into late 2025, early 2026 across official monitoring. And as deficits persist, interest payments rise as rates normalize. This is the key. When debt is this large, the system becomes rate sensitive to a pathological degree. A minor change in yields is not a market move. It is a funding event. So what does the machine do? It encourages duration games, carry trades, basis trades, and leveraged hedges, structures that look stable until volatility forces margin. And here is where shorts explode becomes more than a catchy phrase. In late cycle regimes, short exposure builds in two ways. One, explicit directional shorts, bets that a currency weakens, that an index breaks, that a commodity rolls over. Two, hidden shorts, positions that are short volatility, short liquidity, or short convexity. You can be long something on paper while being structurally short the thing that matters when stress hits, the ability to exit. In expansion, this grows quietly. Verified. Stage 3, crisis. This is where the present begins to rhyme with every prior case. Foreign treasury holdings hit record highs in November 2025, meaning global demand for dollar collateral remains enormous. But China's holdings fell to roughly $682.6 billion, their lowest since 2008, meaning major actors are diversifying at the margin. That's not doom, that's signal. It says the anchor is still used, but it is no longer worshipped as unquestioned. At the same time, trade and financing stress is visible in global plumbing. The Asian Development Bank reported a persistent global trade finance gap of about $2.5 trillion. Gaps like that are not academic. They are symptoms of constrained dollar availability and rising risk filters inside banks. Meanwhile, U.S. fiscal math tightens. Higher interest costs, large spending, deficits that don't vanish just because markets feel better. This is the crisis stage in slow motion. Not a single day of panic, but a tightening web of funding constraints that makes the system brittle. Now add the trigger mechanism. Positioning. When shorts explode, you're seeing an overcrowded expression of stress. And overcrowding does one of two things. It either creates a violent squeeze upward first, forcing shorts to cover into illiquidity, or it creates a vacuum downward, where bids disappear because everyone is leaning the same way, and risk managers all pull exposure simultaneously. Either way, the move is not driven by emotion. It's driven by forced behavior. And that's how the $94 level becomes plausible, not as a prediction, but as a structural attractor. When leverage unwinds, markets hunt levels where collateral terms, option strikes, and systematic flows concentrate. The system falls toward magnets, undeniable. Stage 4, the inevitable outcome. Here's the part most people resist because it sounds like prophecy, but it's actually policy logic. When the anchor becomes too burdensome, the regime must rewrite the promise. In Britain 1931, it was gold convertibility. In 1992, it was the peg. In 1997, it was the dollar link. In our time, it's the real value of the currency relative to obligations. A controlled devaluation can occur in many disguises: inflation tolerance, financial repression, yield curve management, regulatory shifts that force domestic absorption, or coordinated narratives that justify temporary measures. The language changes. The mechanism doesn't. So a $94 crash is not just a chart event. It's the visible expression of the regime choosing relief through repricing rather than relief through austerity. When liabilities are too large, the temptation is always the same: reduce the real burden. Check. Now let me be brutally clear about what this means for you, the viewer, not as investment advice, but as survival logic. In every historical case, the crowd got trapped by believing the anchor was permanent. They believed gold was a guarantee. They believed the peg was unbreakable. They believed the stability band was policy. And they were technically correct, right up until the moment it mattered. This time is different is the most expensive sentence in finance. Not because technology isn't real, not because America has no strengths, not because innovation can't change industries, but because debt mathematics does not negotiate. You can innovate your way into growth, but you cannot innovate your way out of settlement. So here's the actionable takeaway: simple, practical, and grounded. First, stop thinking in headlines, start thinking in balance sheets. When volatility hits, assets don't move because of narratives. They move because collateral is demanded and leverage is cut. If you don't understand who is forced to sell when stress rises, you don't understand the market. Second, respect liquidity over opinion. The right idea at the wrong time becomes a loss if the system is deleveraging. In crisis regimes, liquidity is the asset. Optionality is the asset. Third, diversify across regimes, not across tickers. Most people diversify into things that all fail together under funding stress. True diversification considers what benefits from inflation, what benefits from disinflation, what survives dollar strength, what survives dollar weakness, and what remains liquid when spreads widen. And finally, don't wait for confirmation on the day it breaks. The entire point of a structural warning is that confirmation arrives after the damage. Because that's how the machine works. Stage 1 builds trust, Stage 2 builds leverage, Stage 3 reveals stress, Stage 4 rewrites the promise. Then the cycle begins again with a new story and the same math. If you want to understand what comes after a break toward levels like 94, how the machine was built, how the next stage unfolds, and what the survival playbook looks like when the anchor is being renegotiated, subscribe now and watch the next video. Because the people who survive these cycles aren't the ones who guess the exact day. They're the ones who recognize the pattern while everyone else is still arguing about the headline.